I want you to imagine, just for a second, walking onto a massive institutional trading floor.
Oh, the sensory overload.
Right, exactly. You feel the hum of the servers, you look at the banks of monitors flashing red and green everywhere.
That's an intense environment.
It really is. And you are standing there, holding this pristine, mathematically perfect financial model.
A true work of art.
Yeah. I mean, the equations are perfectly balanced, deriving exactly how a currency option should be priced, down to the 5th decimal place.
Flawless logic.
Flawless. So you hand it to a seasoned veteran trader, they glance at your beautiful math, then they glance up at a breaking news headline flashing on their terminal.
And
they calmly drop your perfect model straight into the trash can.
well, yeah, the math just shatters on contact with reality.
It does. And that singular moment, that collision between elegant academic theory and the incredibly messy, panic-driven reality of the actual market.
That's the defining tension of modern finance, really.
It is. And that tension is exactly what we are unpacking today in this deep dive.
We have some incredible source material to guide us, too.
We do. We're looking at this through the lens of a truly monumental source.
Yeah.
I'm talking about Luigi Pascal Rondanini's 2026 masterclass, FX Options Volatility Trading.
A heavy read.
Very heavy. I mean, if you work anywhere near institutional finance, you know this book. It's 570 pages long, and it operates basically as a desk Bible.
Yeah, it isn't just a textbook filled with stochastic calculus, though there's plenty of that.
Oh, there is.
Right.
But it functions more as a survival manual, for bridging the massive gap between pricing theory and actually keeping your job when the global markets go entirely crazy.
And I think the defining feature of Rondanini's work is just its absolute pragmatism.
Definitely.
It openly acknowledges that the foundational models we use to price risk are, well, deeply, fundamentally flawed.
They are. So our mission today is to deconstruct why those elegant mathematical frameworks are constantly violated by the market.
Right. We are going to examine the fundamental nature of options and explore why the math breaks down in very predictable patterns.
And ultimately uncover where the real power and, the profit in the market actually sits.
I'm looking forward to it.
Me too. Now, for this deep dive, I'm going to step into the shoes of the veteran market practitioner.
That fits you perfectly.
Thanks. I'll be the floor trader who has lived through the crashes, the unpeggings, the sheer chaos of execution.
And I suppose that leaves me with the math.
Exactly. You are going to be our quantitative analyst, the expert who understands the structural frameworks, the statistical distributions.
The pure math that you are constantly yelling at through your screens.
You got it. So let's start at the absolute foundation.
Good idea.
If you are listening to this and wondering why these models fail so spectacularly, we first have to understand the product they're actually trying to price.
Right. We are talking about options.
Yes. And unlike a linear product, like simply buying a stock or buying euros outright, options possess this fundamental asymmetry.
And that asymmetry is really the primitive building block of everything we will discuss today.
Explain that for the listener, just to set the baseline.
Sure. Consider a standard linear trade. Say you buy 1 million euros. If the euro goes up, you make money.
Simple enough.
If the euro goes down, you lose money. Your risk and reward are completely symmetrical.
Right.
But an option fundamentally alters that dynamic. When you buy an option, you are purchasing a right, but absolutely not an obligation.
That's the key right there.
Exactly. It's the right to transact at a specific price in the future.
Let's put real numbers to that so you can really visualize it. Suppose I buy a call option on the euro, giving me the right to buy euros at $1.10 a month from now.
Okay, and you pay a premium for that, right?
Right, let's say $10,000. Now, if the euro skyrockets to $1.20, I exercise my option, buy at $1.10, and ride that massive upside all the way to the bank.
Your profit is theoretically uncapped in that scenario.
Uncapped.
Yeah.
But if the euro completely crashes to 90 cents,
You just walk away.
I walk away, I don't have to buy it. My loss is strictly capped at that $10,000 premium I paid up front.
So you have successfully capped your downside while maintaining all of your upside.
Exactly.
But from a mathematical perspective, pricing that specific asymmetry used to be an incredible challenge.
Oh, it was a mess.
It was. Before the early 1970s, options trading was highly subjective.
Just guys guessing, basically.
Literally. Dealers were relying on intuition, guessing at market direction, and just trying to estimate an investor's personal risk appetite.
It was the Wild West out there until The Black-Scholes framework arrived in 1973.
Right. The Black-Scholes model, along with its specific foreign exchange extension, which is known as Garman-Kohlhagen,
Yes, Garman-Kohlhagen.
it fundamentally revolutionized finance.
Oh, so?
While the brilliance of the model was proving that you could price an option using only observable variables.
No more guessing.
None. You look at the current spot price, the strike price you want to execute at, the time left until expiration. You add in the interest rate differentials between the two currencies and the volatility of the market.
And you just plug all of that in?
You plug those into a differential equation, and it spits out a perfectly objective fair value. You no longer needed to guess about human psychology.
Which sounds amazing in theory, but here is the core practitioner insight right out of Rondanini's book that kind of changes everything.
Let's hear it.
Black-Scholes is a language. It is not a law.
That is a crucial distinction.
It's massive.
Yeah.
Every veteran on the trading floor knows the model relies on assumptions that are just, well, they're completely false in the real world.
The assumptions are structurally massive, honestly.
Break a few of them down for us.
Well, first, the model requires markets to trade continuously without any gaps.
Which never happens.
Right. It also assumes there are zero transaction costs.
Also false.
And most crucially, it assumes that volatility remains perfectly constant over the life of the option.
Wait, constant volatility.
Constant. And that price changes follow a smooth log-normal statistical distribution.
Okay, I mean, anyone who has watched a trading screen for more than 5 minutes knows prices do not move smoothly.
They certainly do.
They gap. They jump overnight. Liquidity completely dries up during news events.
Exactly.
Yet, and this is the crazy part, despite knowing the model is technically wrong, the entire multi-trillion-dollar institutional market still quotes prices and hedges their books using Black-Scholes implied volatility.
Which leads to the obvious question for anyone studying this market: why rely on a broken model?
It's a great question, and I like to think about it like the English language in international business.
That's a good analogy.
Right. Imagine a Japanese manufacturer and a Brazilian supplier trying to negotiate a highly complex supply chain contract.
Oh.
English might not be the native tongue for either party. It might lack the perfect cultural nuance or, the specific vocabulary to capture exactly what they want to express.
But they use it anyway.
They use it anyway because it's the universal standard. Black-Scholes operates exactly as that universal language.
It gets everyone on the same page.
Exactly. It allows competing desks in London, New York, and Singapore to look at a highly complex derivative and instantly understand a quote, even if the underlying calculus is totally flawed.
So the utility of Black-Scholes lies entirely in its universality, not its precision.
Spot on.
And since it functions only as a language, we have to observe how the market actually expresses reality when those core assumptions inevitably fail.
Which they always do.
They do, and that brings us to one of the most important visual phenomena in all of finance, which is the volatility smile.
The smile, if Black-Scholes were a strict law of physics, the volatility smile wouldn't even exist.
It wouldn't.
If you plotted the implied volatility of options across all the different strike prices, it would just be this flat, boring horizontal line.
Because constant volatility means every option on that currency, regardless of how far away its strike price is from the current market, should trade at the exact same volatility.
It doesn't.
No, when you look at actual market data, the line forms a distinct U-shape.
The smile.
Right. Options that are far away from the current price, those deep out-of-the-money options, they trade at significantly higher implied volatilities than options hovering right at the current market price. The chart literally smiles at you.
And the reason the market overrides the math to create this shape is because the market has a memory.
It remembers the pain.
It remembers the pain. It knows about fat tails.
Ah, fat tails. Let's unpack the math behind a fat tail for a second.
Go for it.
In a standard log-normal distribution, the classic bell curve that Black-Scholes assumes.
The smooth one.
Right. Extreme events are statistically vanishing.
Yeah.
A massive multi-standard deviation market crash should theoretically happen like once every 10,000 years.
Which is hilarious because we know from empirical reality that extreme events happen constantly.
All the time.
A sudden central bank rate cut, a geopolitical shock, a major bank collapsing over a random weekend.
These events push the tails of the bell curve outward,
right,
making them much thicker or fatter than the model predicts.
And the market is acutely aware that those chaotic extremes happen. Therefore, dealers charge a massive premium for options that would pay out during a crash.
So the volatility smile is just the physical manifestation of the market pricing and human panic?
Perfectly said. Because it's problems, doesn't it?
Oh, the smile creates a profound hedging nightmare for a quantitative analyst.
Like that.
Because when the underlying currency price inevitably moves, that smile moves with it.
Right, the current price shifts.
Yes. So the desk is forced to choose between two competing hedging frameworks: sticky strike versus sticky delta.
This is where the headache starts.
It really is. You have to decide how you believe the smile behaves. Does the smile stay anchored to the absolute price levels? That's sticky strike.
Okay.
Or does the smile slide horizontally along the chart, keeping its shape relative to the new current price? That's sticky delta.
And if you are managing a massive institutional portfolio and you guess the wrong regime, your hedges will invisibly bleed millions of dollars as the market drifts.
It's a very expensive mistake.
But let me step back into my trader shoes here and push back on this quantitative obsession for a minute.
Please do.
Isn't this nuanced sticky delta debate just a way for quants to overcomplicate a simple market panic?
I would say overcomplicate.
I mean, let's talk about a real fat tale. January 15th, 2015.
Oh, wow, yes.
The Swiss National Bank completely abandoned their currency pegged to the euro.
A truly historic market discontinuity.
That's a polite way to say it. The Swiss franc gapped instantly. There was no continuous trading.
None at all.
There was no smooth curve. The bids on the screen literally vanished. The market went from 120 directly to 0.85 in a complete vacuum.
It was unprecedented.
So when a central bank drops a bomb on the market like that, your nuanced sticky delta map doesn't just fail, it becomes completely irrelevant, doesn't it?
Well, you were describing a true jump, and yes, the continuous hedging models absolutely fail spectacularly in that specific environment. If a desk had a stop-loss order sitting at 118 and the market instantly gaps to 0.85, that stop-loss is entirely meaningless.
Because there is no liquidity available to actually execute it.
Exactly. The math cannot prevent the shock. However, understanding the distinction between sticky delta and sticky strike isn't about perfectly predicting an apocalypse.
What is it about then?
It is about day-to-day survival in the immediate aftermath.
Okay, walk the listener through how that survival actually plays out.
Well, Rondanini notes that under normal, mundane conditions, markets exhibit sticky delta behavior roughly 70% of the time.
Okay, 70%.
But the moment the market enters a period of high stress, it rapidly shifts towards sticky strike behavior.
A regime shift.
Yes. And if you do not track which specific regime you are operating in, the underlying calculation of your delta, your baseline hedge ratio, will be entirely wrong.
Oh, I see.
You might look at your screens and think you are perfectly neutral, when in reality, the regime shift means you are underhedged by 50 million euros. So the math determines if your structural foundation holds up while the rest of the market is panicking.
That makes a lot of sense. And connecting theoretical pricing to the gritty, physical reality of the market brings us to how these massive trades are actually executed.
Execution is a whole different beast.
It is. People outside the industry tend to think of modern finance as supercomputers, trading with other supercomputers in a dark room at the speed of light.
A lot of algorithms just fighting it out.
Right. But Rondanini drops a fascinating practitioner insight here that shocks a lot of people.
And that is?
Voice still wins for size.
Yes. The data on market microstructure here is highly counterintuitive.
Very much so.
We know that roughly 35 to 40% of the total number of trades in the FX market are now executed electronically.
Right. You have platforms like Bloomberg FXGO or single dealer application screens handling immense daily traffic.
Lots of small trades flying around.
Exactly. Yet the actual volume, the sheer dollar amount of risk changing hands, is still heavily dominated by traditional voice brokering.
Which sounds archaic until you understand the mechanics.
Right. If I am sitting on the floor and I need to execute a standard, 10 million euro corporate hedge, I will absolutely punch it into the electronic platform.
It's efficient.
Super efficient. The algorithm sweeps the dealers, finds the tightest spread in milliseconds, and the trade is done. But if I am holding a 500 million euro USD 25 delta put,
that changes things.
If I try to execute $500 million of volatility risk electronically, the screen will literally go blank.
Just completely shut down.
Algorithms will reject it.
Because the underlying algorithms are programmed with strict parameters to manage inventory risk. They provide seamless liquidity in standard, digestible sizes.
Right.
If an automated pricing engine instantly absorbs €500 million of risk, it faces an immediate crisis.
It panics.
It has to offload that risk into the interbank market. And the moment it starts mechanically buying or selling to hedge itself, it alerts the entire global market to its position.
Which shifts the price aggressively against its own book.
Right. It's corporate suicide for an algorithm.
So for trades of that institutional size, you cannot rely on code. You have to rely on market structure. You have to pick up the phone and call a human dealer.
Human relationships govern the extremes of the market.
They really do. I need to call a dealer who fundamentally understands my historical flow pattern.
They need to trust you.
Exactly. That human dealer knows I am a corporate treasurer hedging a genuine underlying physical supply chain exposure.
You aren't just speculating.
Right. They know I am not a toxic hedge fund operating on leaked macroeconomic data trying to front-run their book.
The electronic screen tells you where the market currently is. But the telephone is what actually gets the massive trades done.
Yes, but transitioning massive risk over the phone introduces a completely different vector of operational hazard.
Oh, absolutely. This is where the theoretical Greek letters, delta, gamma, vega, collide violently with back-office settlement reality.
It's a bloodbath sometimes.
Rondanini issues a stark warning in the text about this. He says, confirm the convention before you hedge.
This is the classic silent killer on the trading floor. Let's explain why.
Well, in an academic textbook, delta is simply a mathematical output. It is the first derivative of the option price with respect to the spot exchange rate.
Just a neat little number.
Right, it tells you your hedge ratio. But in the physical market, a trader asking for a quote on a 50 delta call can mean 3 entirely different things depending on how that specific desk calculates the math.
Are they quoting spot delta?
Exactly. Or are they quoting forward delta, which adjusts for the interest rate differentials over time?
Right.
Or are they quoting premium adjusted delta, which subtracts the premium you haven't actually paid yet?
It is so dangerous. Let me give you a visual analogy for how dangerous that mismatch actually is.
Please do.
Imagine two brilliant engineering firms tasked with designing a massive suspension bridge, starting from opposite sides of a river.
Okay.
They agree on all the structural physics.
Yeah.
But one firm is using the metric system, and the other firm is secretly using the imperial system.
Oh no. The structure is doomed before the first beam is placed.
Doomed. When you execute a 500 million euro trade over the phone, you might assume the dealer is quoting spot delta.
Because that's your standard.
Right. But if you are trading an emerging market currency pair, the dealer is likely using premium-adjusted delta as their default convention.
And the scary part is, it doesn't trigger an error code.
Never. The trade confirmation ticket clears the back office perfectly, but your hedge ratio is fundamentally misaligned from the very first second.
You are hedging 50 million, and they're hedging 49 million.
Exactly. It is a silent, invisible error that slowly bleeds your portfolio every single time the market moves, because your bridge is never going to meet in the middle.
Wow. So the operational mechanics, the quoting conventions, the verbal communication, the settlement protocols, they are arguably more critical to survival than mastering stochastic calculus.
Without a doubt, which sets up the final overarching theme of Rondanini's work.
Right. If the algorithms freeze during big trades and human relationships dictate liquidity, where does the real power in institutional finance actually reside?
I can tell you where it doesn't sit. It absolutely does not sit with the smartest quant in the room.
Fair enough.
It sits with the dealer who sees the most action.
This section of the book dismantles a lot of public misconceptions about how major banks actually generate revenue.
Oh yeah, everyone thinks it's simple.
The assumption is that market makers simply act as toll booths, clipping the bid-offer spread, buying an asset at a slightly lower price, and immediately selling it at a slightly higher price.
But the reality of managing an options book is infinitely more complex.
You are constantly managing inventory risk.
Yes, and you are aggressively trying to avoid adverse selection.
Let's define adverse selection quickly.
Sure, it is essentially the danger of trading with clients who possess information you lack. Right, like if a massive macro hedge fund suddenly wants to buy aggressive out-of-the-money puts on the yen, they might know a central bank rumor you haven't heard yet.
You definitely want to avoid that flow.
You do. The true holy grail for a dealer is something called flow internalization.
Flow internalization is the ultimate structural advantage.
Walk us through it.
It occurs when a major dealer can match a client buying a specific option directly against another client selling a highly correlated option entirely within their own proprietary book.
So they never go to the wider market.
Exactly. By crossing that flow internally, the dealer captures the spread from both clients, but they hold zero net market risk. They do not even need to access the external interbank market to hedge the position.
Which brings us to arguably the most powerful practitioner insight in the entire text.
And that is?
The franchise is the flow.
Right.
Think about it. If I am sitting on the central trading desk of a Tier 1 global bank and my franchise brings in 200 massive corporate client inquiries a day, I can literally watch which way the global market is leaning in real time.
That sheer informational advantage is incredible.
It is worth infinitely more than possessing a slightly better stochastic pricing model.
Rondanini phrases it perfectly. He says the model simply prices the option, but the flow tells you the actual direction of the market.
And dealers leverage that massive flow to structure highly complex bespoke products.
Because the margins are better.
Way better. We read throughout the text that the dealer margin isn't the complexity.
Right. A standard vanilla option is incredibly transparent.
Too transparent. The client can check the fair value on any Bloomberg terminal.
So to increase margins, banks add layers of complexity.
They do. They add a knockout barrier, meaning the option ceases to exist if the spot price touches a specific level.
Or they add an Asian feature, which averages the price over a month rather than looking at a single expiration date.
And every single layer of complexity obscures the true fair value of the instrument from the client.
Because the client has no way to independently verify the intricate pricing of a bespoke, hybrid, exotic structure.
None at all. So the dealer is able to embed a significantly larger profit margin into the trade.
Which makes total sense from the bank's perspective.
It does. But I have a philosophical question for our quantitative analysts here.
Go ahead.
If the dealer with the deepest franchise and the most order flow always wins, and if they generate their biggest margins by hiding behind the mathematical complexity of exotic structures, does a perfect quant model even matter? Or is quantitative analysis really just a highly sophisticated shield to protect the bank from blowing itself up, while the sales team and the human relationships actually drive the revenue?
That is a brilliant framing, and I would argue the reality is entirely symbiotic.
Okay, how so?
The quant models absolutely function as a shield. They calculate the regulatory risk reserves, they map the Greeks across massive portfolios, and they prevent the institution from taking on existential, unhedged tail risk. You simply cannot operate a modern derivatives book without them.
I'll concede that.
However, you are entirely correct that the mathematical models alone do not generate alpha.
They don't.
The true profit generation comes from the franchise, the relationships, and the structural advantage of seeing the flow. The model keeps you alive, but the flow makes you rich.
The model keeps you alive, the flow makes you rich. I love that.
It's the reality of the floor.
If we distill this 570-page masterclass down to its essence for you listening, whether you are a corporate treasurer managing global supply chain hedging, or just someone fascinated by the hidden mechanics of global finance.
Well, the ultimate lesson from Rondanini's work is recognizing the limits of theory.
Mathematical models like Black-Scholes are indispensable maps for navigating the market. But true professional expertise is recognizing the exact moment when the map no longer matches the territory.
Knowing the mathematics gets you onto the trading floor, knowing exactly when the market requires you to throw that mathematics out the window is what gets you the corner office.
That leaves us with a final, rather provocative thought to ponder as we wrap up this deep dive.
Let's hear it.
We are rapidly accelerating into an era where markets are becoming increasingly automated. I mean, artificial intelligence and machine learning algorithms are getting exponentially better at pricing vanilla options and managing standard middle-of-the-bill curve risk.
They are taking over the mundane tasks.
They are. So as those algorithms completely conquer the predictable, highly modelable aspects of everyday finance, it forces us to ask where human value actually remains.
Will the only true alpha left in the market be found out in the extremes?
Exactly. Out in the unmodelable human panics, the geopolitical shocks, and the fat tails that algorithms are intentionally programmed to shut down and ignore.